$4,180 for gold on a day of peace talks. That makes no sense unless you think oil prices are about to spike again. Monday, June 29th, 2026. Like and subscribe for daily market updates. Today's agenda: Hook Market Snapshot, Macro and Central Banks, Geopolitical Status, Commodities and Crypto, Earnings, IPO and Deals, Closing Summary. Up next, Market Snapshot. It's Monday, June 29th, and the market is exhaling and holding its breath at the same time. Over the weekend, the fragile 60-day truce between the U.S. and Iran nearly shattered. American forces struck Iranian targets on both Friday and Saturday. Iran's Revolutionary Guard fired back with drones and missiles that set off alarms in Kuwait and Bahrain. And then, late Sunday, both sides abruptly agreed to stand down and reopen the Strait of Hormuz to shipping. That 11th-hour pause is why stock futures are higher this morning, with oil still near 4-month lows. This is the most loaded short week of the summer, and it ends Thursday, because markets close Friday for the 4th of July. That brings us to macro and central banks. Last week was tough for tech, but steady elsewhere. The S&P 500 finished Friday just above 7,350, nearly flat, yet shed about 2% over the week as the AI trade wobbled. The Nasdaq closed near 25,300, dragged down by chip makers. Micron fell almost 7% on Friday despite strong results, as investors questioned how richly these names are priced. The Dow held up best, ending just under 51,900, a whisker from a record high. Overnight, the loudest headline came out of Asia. South Korea's Samsung and SK Group unveiled plans to spend up to $1.3 trillion over the next decade on semiconductor plants and AI data centers. SK Hynix is a top supplier of high-speed memory chips for NVIDIA hardware, making this a direct bet on the AI boom. Yet both stocks fell, Samsung nearly 5%, SK Hynix 3%, as investors balked at the cost and execution risks. At home, Alphabet officially replaced Verizon in the Dow starting today, tilting that old economy index further toward big tech. This morning, U.S. futures are higher on ceasefire headlines. Dow futures up around 160 points and the Nasdaq 100 leading, up about 0.7%. The VIX sits around 18, a calm reading. Money has rotated out of crowded tech into healthcare, industrials, and smaller companies. In fact, the equal-weighted S&P rose last week even as the headline index fell. That indicates a broader market than scary headlines suggest. This inflation pressure is directly linked to global political tensions, so let's talk about the Iran situation next. The backdrop for all of this is an inflation problem that just won't quit. On Thursday, the Fed's preferred inflation gauge, known as PCE, which tracks what Americans actually pay across a broad basket of goods and services, came in at 4.1% for the year through May, the hottest reading since early 2023. Strip out food and energy, and the core figure was 3.4%, also a multi-year high. And yet the consumer kept spending, with both income and outlays up 0.7% on the month. The Fed's interest rate sits in a range of 3.5 to 3.75%, and here is the shift that is quietly reshaping every market. Under new chair Kevin Warsh, the Fed has stopped talking about cutting rates and started signaling a possible hike. Its latest dot plot, the chart where each official privately marks where they think rates are headed, now points to higher rates by year-end, and traders see a real chance of an increase as soon as the fall. Rewind to January, when the world expected 2 or 3 cuts this year. That entire script has been torn up. The bond market agrees. The 2-year Treasury yield, which tracks Fed expectations most closely, is pressing toward fresh 2026 highs near 4.1%, and the dollar is camped at a 13-month high. The verdict: inflation is too hot to wave away. The consumer is still strong, and the single most important clue lands Thursday with the June jobs report, pulled forward a day by the holiday. With oil prices so sensitive, let's look at how commodities and crypto are reacting to this global chaos right now. The primary story driving markets remains Iran. A conflict erupting late February choked the Strait of Hormuz, which carries roughly 1/5 of global oil, pushing crude past $120 per barrel. Now a fragile U.S.-Iran deal is reopening that waterway. Tankers are sailing again, Saudi Arabia loads at full speed, and Gulf exports have recovered to about 3/4 of pre-war levels. However, fragile remains the operative word. Trouble flared Thursday when Iran struck a cargo ship in the strait. The U.S. retaliated with strikes Friday and Saturday. Iran's Revolutionary Guard responded with projectiles triggering alarms in Kuwait and Bahrain, prompting Vice President Vance to warn that further attacks would invite force. By late Sunday, cooler heads prevailed, Both governments agreed to pause hostilities and keep the lane open, while technical negotiations continue. Consequently, markets price peace this morning, but quietly buy insurance against a collapse of that truce. A second front warrants watching. On Friday, the U.S. brokered a framework deal between Israel and Lebanon, yet within a day Hezbollah's leader rejected it outright as surrendering sovereignty. This underscores that regional tensions remain high. Any thread can snap back into oil prices overnight. For investors, crude presents mixed signals. Cheaper energy eases inflation, relieving pressure on the Fed, a genuine benefit. But fresh Hormuz headlines swing energy prices, and a safe place to store wealth demand within minutes. Finally, watch for cracks in OPEC as it coordinates supply. The United Arab Emirates quit the cartel in May, while Iraq threatens to leave unless granted a larger quota. At just the moment global markets need its barrels back. Before we wrap up, let's check what earnings and deals are moving markets this week, with Nike reporting tomorrow after close. Commodities lead with oil telling the full global political story in one number. U.S. crude benchmark crude oil settled below $70 on Friday for the first time since late February, just before Iran's war began, and now bounces back above that level as traders weigh weekend strikes. Brent, the international gauge, tumbled roughly 10% last week to sit near $72.5. A notable twist: gold and silver are lower this morning. Gold slips toward $4,060 an ounce, while silver trades near $58. Why do safe havens fall on a day of war jitters? Doubts about the truce nudge oil prices up, reviving inflation fears and supporting expectations for higher rates. That makes gold less appealing since it pays no yield to hold. Now the crypto pulse. Conditions have been bruising. Bitcoin hovers around $60,000, testing a floor traders watch closely after sliding alongside tech stocks. Ethereum is down near $1,570. The primary driver isn't crypto-specific. It's the in favor of higher rates Fed and a powerful dollar. When bank deposits yield more and the dollar strengthens, speculative assets bleed. Proof lies in flows. Bitcoin exchange-traded funds have shed nearly $6 billion over the past month, marking one of the worst stretches of the year. Investor mood gauges flash extreme fear, signaling panic selling as sellers exhaust themselves. Tellingly, a few corporate buyers quietly accumulate at these levels, betting panic is overdone. So here is where we stand with all these pieces coming together. Now, let's summarize what matters most for your money before Thursday jobs report lands at 8:30 a.m. Eastern Time tomorrow. This short week still has a real earnings test. Nike reports tomorrow after the close, and Wall Street is braced for a rough quarter. Profit of roughly 11 cents a share on revenue down about 2 to 4%, with sales in China expected to drop a punishing 20%. The stock has already been hammered near $45, down close to a third over the past year. Nobody expects pretty numbers. The real question is whether CEO Elliott Hill's turnaround is finally steadying margins and clearing bloated inventory. Constellation Brands reports alongside it, with General Mills on Wednesday, a quick pulse check on the American consumer. Finally, let's turn to closing summary. So here's where we stand. The mood is cautiously hopeful, but jumpy. Relief over the Iran ceasefire layered on top of real worry about sticky inflation and a Fed that's leaning toward hiking. The single biggest risk to this rally is straightforward. The truce snaps, oil spikes, and the inflation fight gets harder overnight. The biggest opportunity runs the other way. If the strait stays open and crude keeps falling, it hands both the Fed and the consumer a badly needed break. But everything funnels into one number: Thursday's June jobs report at 8:30 a.m. Eastern. A hot print shoves the Fed closer to a hike. A soft one buys everybody time. Layer on quarter end tomorrow. The reshuffled Russell Index is trading for the first time today, and central bankers gathering in Sintra, Portugal, where Chair Warsh takes the stage. And you've got a compressed, high-stakes week with nowhere to hide. If this is the clear, no-spin market read you want each morning, hit subscribe and turn on notifications. A short week moves fast. Oil trades near $73, yet any spike above $72 could force the Federal Reserve to reconsider its rate path sooner than expected. Strengthening dollar sentiment and inflation fears have pressured gold and crypto ahead of Thursday's jobs report. Nike earnings later today may also signal broader retail weakness if China sales miss again this quarter. The primary risk remains a snap in recent truce talks, which would reignite oil prices and complicate the Fed's stance under new chair Kevin Warsh. Conversely, sustained calm could provide relief for growth stocks before volatile price swings hit following the holiday-shortened jobs data release tomorrow morning. Thanks for watching Market Pulse Daily.